The all of this markup in here I gave by way of Thursday's post to the forum, and then we have Friday's price action in here. Now again, go back and listen and watch the recording on Wednesday, because I gave you a condition for euro. I wanted to see the buy side liquidity pool above these relative equal highs. I wanted to see that attacked, and I wanted to see it when ECB came out. I wanted to see the gap that was here left open, and I wanted to see it occur on the heels of ECB going into Draghi. That's what I wanted. And we didn't get that. We actually got it early. Okay, so I'm going to give you another if-then algorithmic theory. I outlined it very clearly. All the context is in Wednesday's video. I wanted to see this gap left open. I wanted to see it run into this area here during the ECB related news. Then I wanted to see Draghi talk, and whatever he would say, I could care less what it is he said, but the fact that he was flapping his gums would be enough to send them looking for a higher price in euro on its daily chart. Neither of those conditions occurred. We had a run to the liquidity pool, which was outlined, and it was a 30 pip run, but it occurred at the wrong time, and it was ahead of the volatility injection because of ECB related news and then Draghi. So if they run the liquidity that we were looking for as the first objective in a run higher, what have they done essentially? Well, think about it like this. Again, algorithmic theory. If price can hold a gap here and then run up into this liquidity pool during the 8:30 hour, or some, sorry, it was like 7:30 or whatever it was, and then at 8:45 when Draghi was talking and do his normal thing, we could see a continuation and run into that 112, and it spread up into the 112.20, 112.40 level. Okay, but it would require Draghi to talk the right way for the banks to have that smokescreen, and then they would reprice euro, accordingly. Since we did not get that, so if those conditions were there, which they did not present themselves, what are we left with? If this does this at the right time and the price is delivered the way we were expecting, we would expect further upside. But because it did not, we have another if statement. So if it doesn't do that, what are we left with? We have to look for that daily fair value gap on the euro. And let's go out to a euro chart, and I don't want to give you any additional notes on that because these notes I want to save. So here is the euro. So if the bullish condition that we outlined, while it still offered pips on the upside, and they were all manageable setups, you could have taken 25, 30 pips out of these moves. The larger daily chart in this imbalance here that we talked about, I said if the Draghi related ECB announcements was unable to send it higher above this high here, that was the high I had outlined. Remember I told you I had the line, I said it wasn't anchored on anything over there. It's just this high here. Well, if we were to trade through that, then our attention would have been taken over here to these relative equal highs. But the statement was, if it cannot and it goes lower, if it can't go higher, it will go lower. And to where? I gave you a specific condition. If it doesn't go higher on the Draghi scenario, all the ECB stuff, I gave you the things that I was looking for from the signatures. I wanted the price run above the equal highs to happen during the Draghi related portion of the day. If it does it ahead of time, it's lower probability. Because it didn't do it, this was going to be the rebalance point. I said, okay, then it'll go lower, and all of this would be rebalanced. Again, go back and watch the first maybe 7 minutes of the video from Wednesday. I think it'll do it. If not, just make sure you watch the whole portion of the euro. So let's go back into the 20-minute chart here. So since it did this early, while the price offered a tradable run, it does not fit the narrative that I was giving you on Wednesday. So if this does not occur, what are we left with? We're left with another if statement. So if this doesn't produce the run that we're looking for, then we have to turn our attention to that daily fair value gap as a downside draw on liquidity. Here's the top of the fair value gap, that line here, and here's the low end of that fair value gap on the daily chart. So that's what these levels are highlighted here, okay? I also stated in the video, and I think it's the 4-minute mark or so, I said if we take out Wednesday's low, we will see the complete filling in of that daily fair value gap on Euro USD. Here's Wednesday's low. It runs it here, okay? Thursday we run through it. Great. Maybe you didn't take anything here. Maybe you didn't sell it in here. Maybe you didn't do the institutional order flow entry drill technique here and capture pips. Okay, great. Who cares? Fast forward to Friday. We had consolidation. Price runs right back up into mitigation. In this area, we have a rebalance. This area here is also equilibrium of the price run from here and here. And I'll give you notes in a moment. But we have the fair value gap closure here, and then it runs a little bit more lower than that. Here is the amplified notes. I have a fair value gap here from this high to this low, equilibrium. It returns right back to equilibrium, runs buy side liquidity. So we go up to a fair value gap, into mitigation. What is mitigation? All of this running here, anything they use to go long, they have to undo that, and that's what mitigation is here. And then price comes down into New York. Let me scrunch this out so you can see the full thing here. Here we are. So this is the New York kill zone, beginning of it. We have a SIBI, sell side imbalance, buy side inefficiency. That's the protraction on New York. Trades down again. Now watch, look close, okay? Even on this 15-minute time frame, see all this back and forth price action in here? All this back and forth price action is the same thing that I've outlined on the higher time frame chart for the dollar. Remember I was talking about it over here? All this back and forth price action, that's a balanced price range. Well, the same thing is existing here, just on a smaller time frame. So that's why we see this price run back up into this level here. It's butting into the bottom edge of that balanced price range. So look how much time. It wasn't one single candle that passed through this entire range. Let me highlight that so you can get a real good understanding of what I'm saying here, because this is crucial. If you don't understand this, you're going to really, you're going to struggle. Okay, you're going to have a hard time really appreciating the things I'm showing you when it's not a low resistance liquidity run. All of this back and forth price action, it's balanced. Look how many candles it took to get through all that. And then once we got to the bottom edge of that, then boom, look out, let me zoom in. All of this back and forth, in the shaded area, we have 1, 2, 3, 4, 5 candles, okay? An hour and 15 minutes. And then one single candle, once we get to the bottom edge of it, and then it expands, creates an imbalance. That's when your setup occurs. Refill, rebalance, bottom edge of the balanced price range. There's your New York setup. And then expansion lower. Then we get another SIBI, sell side imbalance, buy side inefficiency. Consequent encroachment trades right to the middle of that. Sells off again. Down into 110.72 and a half. The lower here was 110.92 and a half. Exactly 20 pip grade price run below this low here. So let me zoom out. Wednesday's conditions outlined in advance. We wanted to see specific things occur, but because it happened early, our original if statement, if the conditions are ripe for a higher price move, time and price have to agree. We also have to see certain measures of price create a signature that we've seen many times before that will align with our understanding of what it may do on the higher time frame. Wednesday's low was taken. Let me put the daily dividers back on again. So here's Friday, here's Thursday, and here's Wednesday's low. Wednesday's low was taken. I told you specifically in Wednesday's video that if we take Wednesday's low, we will see a full closure of that daily fair value gap. Now, did it do it on Thursday? No, because here's the bottom end of that fair value gap. right here, the daily fair value gap, the low of it, that's this candle's high. Okay, right there. If we break Wednesday's low, which we did, our attention would be, okay, we can't expect a higher price. That's now out off the table. So we're left with, okay, if you only wanted to be a buyer, then you do nothing. Or you adapt and you say, okay, well, the next draw on liquidity is that daily fair value gap. But the things I'm outlining that would get you in another trade pan out. Now, obviously that sounds like, well, of course, anybody could say that. If it's not going to go up, it's going to go down. The specific conditions that we look for are the signatures I'm trying to teach you. So if you don't look at those things in the proper context, you're going to miss the understanding and the learning from it. Now, let me scrunch this up again. So we have this price swing on Friday. Okay, we have, it's not quite an optimal trade entry. Okay, if you look at the mitigation block right here, trades up into it really nice. Now, you could go and say this is a breaker because it's running a short-term high. I would not call that a breaker. This would be a mitigation block. And why is it a mitigation block? It's because we have a high here and it rolls back up into what would be like an optimal trade entry, and then it breaks that low. This is mitigation. Now, if this was reversed, said this high was higher than this high, then this would be a breaker. So that's the distinction between the two. Okay, I got an email a couple weeks ago. What's the distinction between a mitigation block and a breaker? They are both mitigation by nature. They're mitigating what was used when price was going up. Any positions that they offered as counterparty, because not all of this run is attributed to them buying for the sake of making money going up. They're buying to be counterparty to institutions, commerce, large insurance companies come in. They have to do transactions, global commerce. All those transactions, they're going to need to get off of that because they're holding the risk. So to get out of that position of holding the risk, when it comes back up here, it allows them to mitigate that. Okay, but this optimal trade entry, the low in between is mitigation, or simply the mitigation block. If we have a high, a low, and a higher high, the down candle at the lowest point of the swing low is a specific breaker. Now, what's more stronger? You're probably asking yourself, what's more preferable? Should I look for mitigation blocks or should I look for breakers? Breakers are better at determining when there's going to be a large magnitude move because they've already run stops. Okay, they've already ran stops, and when you trade back at the bottom end of that range, you're going to see a much more sharper responsiveness, and then there's going to be a lot of range because they've already done the dirty work. In instances like this where we have a mitigation block or a traditional optimal trade entry short, you can see a little bit slower, more lethargic move, but it'll still move and it's tradable. But the distinctions between the two, if it was just a plain mitigation block versus a breaker, breakers tend to have a sharper, quicker responsiveness in price action, and they usually want to cover a lot more ground because they want to leave the area that was the crime scene. Basically, mitigation blocks can actually come back up again and hit that, and then you start to see it work its way lower. If it's a personal preference for me, I'd like to find a bearish market structure on a higher time frame chart and then look for bearish breakers, and then I'd have a high probability short scenario. That's my personal election for trading them. But if I've already had that on a higher time frame, like for instance, say the daily's bearish, and then on a 1 hour I have or not so much a 1 hour, say it's a 4 hour bearish breaker, I could look for a 1 hour bearish mitigation block and still be in sync with what I expect to see on the daily and the 4 hour, and still have a larger magnitude move. But that's how I would use the mitigation block. It would have to have some higher time frame backdrop behind it. Then I would be more inclined to trade with my maximum risk. Otherwise, it's not as probable, not that they aren't good setups. They are good setups, but they're not probable for big magnitude and fast delivery, whereas a breaker in most instances will deliver that. All right, so fair value gap filled in New York session. And then we had a smaller civvy and came back up to consequent encroachment there, and then rolled over, and again 20 pip run for a stop rate on Southside liquidity here, and complete closure of the fair value gap at this candle here, and then we still went a little bit lower for good measure. So if I was to look at a clean chart, let's go into a 15-minute time frame on that with no notes on it. Okay, we're right back in equilibrium of this price range here. We hit that. If we get dollar strength this week and we go up into that unfilled daily fair value gap, again, this one here, if we have that occur, euro could trade down to here. Okay, we have relative equal lows, and then we have this fair value gap right there. So it would require not much. It doesn't need to rally up here. If we get immediate strength on Sunday's opening and going into Monday for dollar, that would just send this thing lower. It's got a lot of distribution going on in here with all of the rallies being sold off. Lots of obvious liquidity resting below here. So that would be the near-term draw for me here. I don't see this one yet. It would have to depend on how we trade here if we get to the fair value gap at all. But if we get below that, then I think this would be the next level to be concerned about. And then if we get down here, it completely changes the picture for me for the dollar. And that would probably mean we're going for the daily buy side liquidity on dollar here. And I don't see that yet. You know, all of this in here looks like it's dropped down. They're fluffing it up ahead of FOMC and non-farm payroll. And then I wouldn't be surprised if we see it really make an aggressive run into here. After non-farm payroll, after FOMC, all those factors have to be, that bridge has to be crossed. All right, so in the last bit of business, I had a bearish